Hey everyone, welcome to Fundamentals Unfiltered. I am Matt with the Fundamental Investing Institute. It is the week of September 2nd, 2025. There's a couple of things we want to get to in this episode. I think the two big ones. Number one is the ongoing drama with the Federal Reserve. And I want to talk a little bit about this executive order that was passed last month to allow private funds, to allow retail investors to use 401ks to invest in private funds. It expands access for private equity firms. But the first one is the president, of course, fired, quote unquote, Fed Governor Lisa Cook. And there's a ton of commentary on this. I wanted to weigh in a little bit. What this Fed governor is being accused of doing is basically committing mortgage fraud by listing two residential properties as her primary residence. I believe these applications were made before she was Fed governor. And the Federal Reserve Act gives the president the ability to remove a Fed governor for cause. So the issue at hand is whether this constitutes for cause, because that term cause isn't well defined. It's generally viewed as a high threshold, a dereliction of duty, but it's not clear whether this falls within that definition. So Ms. Cook is, of course, contesting this, has filed lawsuits, and this is going to play out in the courts. So the issue at hand is the ongoing, what this means for Fed independence. And there's a big concern, of course, among commentators and investors that if Fed policy comes under the thumb of political incentives, that it's bound to be inflationary, and I think that is the case. So the difficulty here, of course, is that the media is so full of apologetics and counter-apologetics that it's hard to separate the signal from the noise. And in the financial press, it's generally received as a negative, right? And there's a lot of articles about, is this the end of Fed independence? Is Fed independence going to be greatly reduced? But there's a really good article I wanted to talk about. It was in the Wall Street Journal from James McIntosh, and he put some good perspective to this issue. He brings up a lot of good points, and he's essentially saying that there's still considerable distance between where we are now and what a politically motivated Fed would look like. And one of the points he brings up is, even if you put aside this Lisa Cook issue, the Fed, the majority of the governors are going to be Trump appointees in May. Chair Powell's term, at least in the chairmanship, is up in May. He's not going to be renominated, no question about that. And right now, Trump has 3 seats, not including Powell. 2 of the seats are filled. One of them is going to be temporarily filled, but will be permanently filled soon thereafter. And another point that he brings up is, in and of itself, having the majority of the appointees from a single president does not necessarily mean you have a fully politicized Fed. We saw this, Reagan had the majority of the appointees on the Fed in Fed governors, and this led to some conflict with Paul Volcker in the 80s, but near as I can tell, Greenspan acted pretty independently. And another point that McIntosh brings up in this article is that the 2 current appointees, that is other than Powell, One is a man named Christopher Waller and a woman named Michelle Bowman. I was looking through the Fed minutes of the last Fed FOMC meeting, and Waller and Bowman voted for a quarter point rate cut. They dissented from the majority, but a quarter point is far from the kind of rate cuts that the president is demanding. So that's actually very good news. I mean, it showed that they're still acting somewhat independently. And then the other issue that McIntosh brings up is the names that are being floated for the chairman position. They're all relatively within the economic mainstream. I mean, there's no one. Trump in his first term, he nominated Herman Cain, who was comically unqualified to be on the Fed Board of Governors. Herman Cain was the CEO of Godfather's Pizza, but he just didn't have much of a background in finance. And another one of the names that was nominated was Judy Shelton, who is an economist, but she's an advocate of the gold standard, so she's someone who's really outside of the mainstream. And then he nominated Stephen Moore, who does have an economics background, but he was really more of a journalist and someone who was thought to be kind of partisan. So, for what that's worth, the names that are being thrown out now, people like Kevin Hassert and Kevin Warsh and a number of others, they're still relatively within the mainstream. So I think the point of the article is it's probably too soon to just say much. I think the impetus of this article is that there wasn't much of a market response. There was a little bit of a increase on the yield on the 30-year, but there was a big variance between kind of the commentary and what was actually happening in credit markets. But I just want to share a couple of things that I'm paying attention to as this whole thing unfolds from a capital markets perspective. One is the difference between the yield on the 30-year Treasury and the 3-month bill. Another is the difference to the yield on the 10-year and the 3-month bill. So if those terms widen, what you're seeing is higher inflation expectations. And that could very well be the case. So even if you push down the federal funds rate very aggressively, long-term rates, medium-term rates may not budge much. They may actually increase. And then another thing that we need to pay attention to, I think, is gold prices. Gold is a historical inflation hedge, and I think it's important to note now that gold prices are at or near an all-time high, and I have a hard time believing that that would be the case if monetary conditions were as tight as a lot of people claim. So I just wanted to offer some perspective. I feel very strongly in the independence of the Fed. There's a history here going back in August of 1971. Richard Nixon broke the last link to the gold standard, and throughout the 70s, the Federal Reserve was highly politicized, and we saw what happened in terms of inflation. Paul Volcker became chairman in 1979, and he embarked, along with the rest of the Fed, on a very needed but very stringent period of monetary tightening. It took a lot of pain in order to bring inflation down, and when that subsided, it really set the conditions for the bull market that followed. But it was very painful. Unemployment reached almost 11% in the early 80s. It was a very deep recession, but that's what it took to break the back of inflation. So inflation is something that we should take seriously. But again, as Mr. McIntosh brings up in this article, it's probably too soon to be overly concerned or overly afraid, and we're just gonna, see how this plays out. Another issue that I wanted to bring up is last month the president signed an executive order, which is going to allow people to use their 401k plans to invest in funds that invest in private assets. So, 401ks are relatively conservatively regulated, and this is now going to enhance the alternatives. But I'm going to offer a little bit of a cynical take on this. What's happened in the last few years is that a lot of private equity funds are holding on to their assets longer. They're not able to sell them for the prices that they want. They're holding on to these assets longer, and the institutions that are investing in these funds are not seeing their capital returned. So they're good returns on paper, but without those assets being sold, you're losing an important funding source, because normally those assets would be sold and that capital would be recycled into new deals. So there's a need for new funding sources for that reason. Another thing to keep in mind, the most aggressive area of growth in the private asset world is private credit. And private credit really proliferated after the financial crisis because there was a lot of bank regulation that really tightened traditional bank lending. So these private credit funds came in and filled that void. But there's an interesting thing that's happening here too. There's a great article in the Financial Times on this, and it brings up. I'll see if I can find the name of this article, because it was funny. It says it's not a default if you've never asked for cash, right? Just asking for a private credit fund friend. The point of the article was that you have these very low default rates, but it sort of depends on how you define default. And a lot of these private credits are being restructured, and specifically concerning is that a lot of the yield, a lot of the quote-unquote income into these private credit funds are being paid in kind. And what that means is that the interest is being paid by issuing additional debt. So think about a negative amortization mortgage. We all learned about those during the financial crisis. And this means that the balance of the mortgage actually goes up instead of goes down, which is the exact opposite of what should happen with a loan. And paid-in-kind securities are nothing new. These were very big in the 1980s buyout boom, but a lot of these private credit funds are receiving their income in kind. The problem is, in order to maintain their status as investment companies, these funds have to pay out the majority of their income. Well, what happens when that income is not cash? You have to bring in cash through new funding sources. And this seems to be one of the motivations for trying to tap new funding sources, trying to tap 401ks. Now, this is going to take a long time to play out. The executive order just sort of directed the Labor Department to figure out the specifics. My guess is that this isn't going to roll out until the end of next year, rather. And another thing to keep in mind is that usually when there's new regulatory changes like this, it kind of comes at a drip initially, because there's a lot of uncertainty on the new rules that come out and so forth. So it's going to take some time. I don't want to comment too much because we just don't know what it's going to look like. But I would keep in mind that I think one of the motivations very clearly is that a lot of these big firms really, they need new funding sources. They're not deriving liquidity from existing positions. So it's just something to keep in mind. I don't mean to be overly cynical. I think expansive choices for retail investors is generally good. as long as people are educated as to what they're looking for, and also, I think there's going to be, there's still a fiduciary obligation for the people who manage these 401ks. So there's probably going to be a lot of guardrails to this, but I just think it's something to consider, especially given how much we've paid attention to what's going on with the Jobs Act, which is, to me, it's still a more interesting area for retail investors because they can invest in private deals directly, specific private deals, not just through intermediated funds. So, but those are the to me, those are the two big things that have come out in the last week or so. We're still paying attention to what's happening with the Fed, but Mr. McIntosh's article was really good because it highlighted a lot of it highlighted a framework, or highlighted a context that we're really not seeing in some of the other commentary. And like I said, like most things, we just have to pay attention to what's going on within markets and what markets are telling us, because it's really hard to separate the signal from the noise. And that's what we do here. We focus on the fundamentals, and we try to get past the noise of the media and focus solely on markets. So with that, we will end this week's episode. I hope everyone has a great week, and best of luck in your investing endeavors. If you're learning anything, please hit like and subscribe, and we will continue to roll out new episodes on a weekly basis. Thank you.